OG John AG here. CME just hiked margins again. That's the second massive increase in just 3 days, my brothers and sisters. Silver margins, 11%, 15%, plus 136% increase. CME official, effective after Monday's market close. Gold margins up 33%. And here's what nobody's talking about. COMEX, $114.78, 31%. 85.25 rebound consistent in 1 day, the biggest single-day loss on record. But Shanghai silver futures are trading at $122 right now. Let me say that again. COMEX at 85, Shanghai at 122s. That's a 43% premium. And the Asian markets open tonight. The next 12 hours will decide everything. One important thing for new people here before we go further. I don't sell signals. I don't sell mentorships. I don't sell memberships. I don't sell anything. If anyone contacts you claiming to be me asking for money, block them immediately. I am only on X and YouTube. Handle AOG John AG. That's it. I just share the raw picture of what's happening in these markets so you can see both sides, the bullish case and the bearish case, and make your own decisions. I will never sell you anything. That's my promise to you. Now I want to hear from you. Comment down below with OG John AG and your outlook. What do you think silver will do Monday when Asian markets open? Will Shanghai's 43% premium hold? Will COMEX crash further? Let's connect everything we've discussed this week and see where the community stands. Your perspective matters. Let me take you back to Friday, January 30th, 2026. We had the metals crash. Silver down 31% in a single day, biggest daily loss on record. Gold down 9%, worst day in over a decade. This wasn't normal volatility. This was forced liquidation. Coming right after silver had COMEX, 114.78, 31%, 85.25 rebound, consistent the day before, an all-time high, and after 8 months uptrend before Friday liquidation in silver's history. Friday afternoon, late in the session, the selling intensified. Paper contracts flooded COMEX. Physical dealers couldn't keep up. And here's where it gets critical. Saturday, January 31st, CME Group announced their hiking margin requirements. Gold maintenance goes from 6% to 8%. Silver from 11% to 15%. That's a 36% increase for silver traders. If you're trading one COMEX silver contract, your margin requirement just jumped from roughly $27,500 to over $36,000. You need to post 36% more capital by Monday's close, or you're forced to liquidate. But that's not all. Coming into this week, we had Kevin Warsh nominated as Fed chair. Markets initially read him as extremely hawkish, bearish on precious metals because of potential balance sheet tightening. Then we had Trump deploying troops and warships to the Middle East. Iran, regional war warning diplomatic channels. That's a direct quote from Iran's state media. Geopolitical tensions spiking. And Bitcoin closed Friday at $78,626, down from over $84,000 just days earlier. It's now sitting at $76,899 as of this morning, February 2nd. If Bitcoin breaks $74,000, Michael Saylor goes underwater on his leveraged BTC position. That's a psychological level that could trigger panic selling across crypto and bleed into metals. The official line from CME is better risk coverage after extreme volatility. That's what they say publicly. But traders see this as a deliberate move to squeeze over-leveraged positions. They're forcing liquidation. They're clearing out the speculative froth. And here's what I'm watching. Will physical demand in Asia absorb this paper selling? Or will one more wave of forced liquidation drive prices even lower before the bounce? Now let's talk about the numbers. The disconnect between physical and paper is absolutely insane right now. Shanghai silver currently trading at $122 per ounce equivalent on the Shanghai Futures Exchange. COMEX silver at $85.25 as of Friday's close. That's a 36.75 premium. Let me calculate that for you. That's a 43% premium for Shanghai over COMEX. Think about this for a moment. You have two global exchanges trading the same commodity at prices that are 43% apart. That doesn't happen unless something is broken. But wait, it gets crazier. According to reports from Chinese e-commerce platforms, JD.com, that's one of China's largest online retailers, has silver bars listed at 850 yuan per gram. That converts to approximately 163s per ounce. COMEX is at $85. JD.com retails silver at 163. That's a 91% premium. Let me say that again so it sinks in. Chinese retail buyers are paying $163 per ounce, while COMEX paper silver trades at $85. That's a 91% premium. You cannot reconcile that. You cannot have physical silver trading at 91% premiums on retail platforms while paper contracts crash 31% in one day. One of these prices is wrong, and history tells us the physical price is real. Paper can be manipulated. Physical cannot. Now let's talk about what dealers are saying. Saturday, January 31st, the day after the crash, multiple bullion dealers posted statements. I'm seeing reports that sourcing physical silver has become difficult to near impossible. That's not my words. That's dealers on the ground. Mints are operating under enormous backlogs. Retail demand has exploded. People saw the price crash and rushed to buy physical, but there's nothing available. According to data from earlier in January, 33.45 million ounces of silver were physically withdrawn from exchanges for delivery in just 7 days. That's roughly 26% of COMEX registered inventory moving in 1 week. Physical holders in China and India are not selling at $85. They're not even selling at $100. They're holding or buying more. The disconnect is screaming. Now, CME margin data. Let's go through this carefully because this is where the pressure is building. Before the first margin hike on January 28th, silver maintenance margin was around $25,000 per contract. After the first hike, it jumped to roughly $27,500. Now, effective after Monday's close, it's going to $36,000. That's a 44% total increase from where we started 3 days ago. Gold went from approximately $20,000 to $26,400 per contract, a 32% increase. Here's what that means practically. If you're a trader holding 10 silver contracts, you just went from needing $250,000 in margin to needing $360,000. If you don't have that extra $110,000 by Monday's close, your broker force liquidates your position. That's more selling pressure. That's more paper dumped onto COMEX, and that's exactly what CME wants. Clear out the leverage, shake out the weak hands. Let's talk Bitcoin for a second because it matters. Bitcoin, 78.6K, 76.9K, February 2nd. It's at 76,199. That's down 8.4% from Thursday's level of 84,126. Bitcoin needs to hold above $78,000 minimum. If it closes tonight above $82,000, that's bullish for Monday's metals opening. But right now it's sitting at $76,899 and looking weak. The critical level everyone's watching is $74,000. That's where Michael Saylor's average BTC purchase price sits. If Bitcoin breaks $74,000, MicroStrategy's entire position goes underwater. That triggers psychological panic. That could cascade into more crypto selling, more liquidations, and more pressure on alternative assets like silver and gold. Now, geopolitical factors. This is not some distant risk. This is immediate. Trump deployed troops to the Middle East last week. Iran responded with a direct warning through Qatar's foreign minister, who delivered the final message. If the Americans start a war, this will be a regional war. That's not bluster. That's an official warning delivered through diplomatic channels. Rising Middle East tensions have historically driven safe haven demand for gold and silver. But in the short term, if traders are being forced to liquidate due to margin calls, even geopolitical risk won't save the price. Forced selling overwhelms fundamentals in the near term. But once the liquidation is complete, geopolitical fear becomes a powerful catalyst. Here's where the story takes another turn. Let's talk about Warsh. Kevin Warsh, Trump's pick for Fed chair. When his nomination was announced, markets immediately sold precious metals. The narrative was, Warsh is a hawk. He's going to tighten policy. He's going to shrink the balance sheet. He's bearish for gold and silver. But here's Warsh's actual nuance that most people missed. Warsh is bullish on AI. He's bullish on productivity gains. He believes rate cuts are necessary to support growth, but he wants balance sheet discipline to prevent runaway inflation. Markets heard balance sheet discipline and sold metals, but they missed the part where Warsh, hawkish, balance sheet, initial sell-off, are bullish for non-yielding assets like gold and silver. The initial bearish reaction may have been a misread. The market panicked first, asked questions later, and now we're seeing the forced liquidation that follows panic. Let's address both scenarios for Monday's Asian opening. I'm going to give you the bearish case first, then the bullish case. You need to hear both sides. Bearish case, number 1. CME margin hikes take full effect Monday. Traders who can't post the extra 36% capital for silver, 33% for gold, will be forced to liquidate. That's more paper selling. That overwhelms any physical buying in the short term. Number 2. Bitcoin is sitting at $76,199. Dangerously close to the $74,000 level where Michael Saylor goes underwater. If Bitcoin breaks that level tonight or Monday, panic spreads across crypto. Leverage positions unwind. That psychological fear bleeds into precious metals. Traders sell everything. Number 3. Asian markets open tonight and gap down. If Shanghai opens weak, if Hong Kong and Tokyo follow with selling, that sets a negative tone for European and US markets. Momentum traders pile on. Short sellers smell blood. We could see another leg down. Number 4. The Warsh nomination narrative, even if misunderstood, has created bearish sentiment. If that sentiment persists and traders believe the Fed will tighten, they keep selling metals despite physical scarcity. Number 5. If retail buyers hesitate, if Indian and Chinese buyers step back temporarily waiting for even lower prices, physical demand doesn't show up fast enough to absorb the paper selling. In that scenario, COMEX could test $75 or even $70 before finding a floor. This is the bearish scenario. Paper overwhelms physical short-term. Forced liquidation drives one more violent leg down. It's possible, it's real, and you need to be prepared for it. Now here's the bullish case. Number 1. Physical holders in China and India are not selling. Shanghai silver at $122 while COMEX trades at $85 tells you everything. Chinese buyers are paying 43% premiums. Retail buyers in China are paying 91% premiums on JD.com. They're not selling, they're buying. Number 2, dealers can't source metal. Multiple bullion dealers reported Saturday that physical silver is difficult to near impossible to source. Mints are backed up. Retail demand has exploded. This creates a solid floor. Physical scarcity prevents prices from staying suppressed for long. Number 3, the margin hikes might be the last desperate move. CME already hiked once on January 28th. Now they're hiking again. If this doesn't shake out the leverage positions, they're out of tools. Once the liquidation is complete, the path of least resistance is up because physical fundamentals haven't changed. Number 4, history says this is a buying opportunity, not the end. Every time we've seen 30% or greater discounts from fundamental value, where paper prices crash but physical premiums explode, silver has bounced back hard. This has happened before. 2008, 2011, 2020, every time the physical market eventually overwhelms the paper manipulation. Number 5. Silver just had 8 consecutive months up before Friday crash, the longest winning streak in history. Gold had 7 straight months green. That's not speculative froth. That's a structural bull market driven by currency debasement, geopolitical uncertainty, and industrial demand. One day of forced liquidation doesn't erase that. Number 6. If Bitcoin holds $78,000 or bounces back above $82,000, that removes a major fear factor. Crypto stabilization helps metals stabilize. Number 7. Geopolitical risk is real and escalating. Iran warnings, Trump troop deployments, Middle East tensions, these don't go away. Once the forced liquidation is done, safe haven demand roars back. This is the bullish scenario. Physical reality finally overwhelms paper manipulation. The disconnect is unsustainable, and Monday's Asian opening could be the moment where physical demand steps in and says, no more. Here's Warsh's actual nuance that most people missed. He's not just a hawk. He's bullish on AI and productivity. He believes in rate cuts to support growth. He just wants balance sheet discipline to prevent inflation from spiraling. Markets may have overreacted to the bearish side of his stance and ignored the bullish parts. If the market reassesses Warsh this week, that removes a major headwind. Monday comes down to this. You need to watch 4 things. First, Asian opening tonight. Shanghai, Hong Kong, Tokyo, they open before U.S. markets. If Shanghai silver holds at $122 or rises, that's bullish. If it gaps down below 110, that's bearish. The Asian session sets the tone for everything. Second, Bitcoin action overnight. Bitcoin needs to hold $78,000 minimum. If it bounces above $82,000, that's bullish for metals Monday. If it breaks $74,000, that's a major problem. Michael Saylor going underwater creates psychological panic. Third, Iran news. If geopolitical tensions escalate over the weekend, if there's any military action or threat escalation, that drives safe haven demand. Watch the Middle East headlines. Fourth, whether CME margin hikes trigger more forced selling. Monday afternoon, after the market close, those new margin requirements take effect. If traders can't post the capital, they liquidate. That's the final wave of paper selling. After that, the pressure lifts. Where does this leave us? 3 key takeaways, and we're out. Number 1, CME margin hike, second time in 3 days. Gold margins up 33%, silver up 36%. This is forced liquidation, pure and simple. But here's the critical part. Physical dealers shut down. Multiple dealers saying sourcing silver is difficult to near impossible. Shanghai premium at 43%. Chinese e-commerce platform JD.com showing 91% premiums. Paper and physical are completely disconnected. Monday's Asian opening decides which reality wins. Does physical scarcity create a floor and bounce? Or does one more wave of paper selling drive COMEX lower before physical demand steps in? The next 12 hours will tell us everything. Number 2. Bitcoin at 76,799, down from 84,126 just days ago. That's an 8.4% drop, and it's looking weak. I said watch for a close above $82,000. That would be bullish. We didn't get it. Bitcoin is now dangerously close to $74,000, where Michael Saylor's average purchase price sits. If Bitcoin breaks that level, psychological panic spreads. But here's the flip side. If Bitcoin holds and bounces back above $80,000 Monday, that removes a major fear factor for metals. Asian markets opening tonight. Shanghai futures, Hong Kong, Tokyo, they open first. They set the tone. The next 12 hours matter more than anything. Number 3, Warsh policy is more nuanced than the initial bearish reaction. He's not just a hawk. He's bullish on AI, productivity gains, and Warsh, hawkish on balance sheet. Initial metals sell-off. He wants balance sheet discipline, but that's not the same as aggressive tightening. Markets may have overreacted. Silver just had 8 consecutive months up before Friday crash, longest winning streak in history. Gold had 7 straight months green. This is a structural bull market driven by fundamentals, not speculation. Friday was forced liquidation, not a change in fundamentals. History says when paper crashes but physical premiums explode, the physical price wins eventually. But Monday's opening will confirm or deny whether that pattern holds this time. The unresolved tension is this: physical scarcity at extreme levels, dealers shutting down, premiums at 43% in Shanghai, 91% on JD.com in China. But paper markets seeing margin hikes twice in 3 days, forcing more selling. Bitcoin weak at 76,899, dangerously close to $74,000. Iran tensions escalating in the Middle East. All these forces are converging Monday morning when Asia opens. Does physical reality finally overwhelm paper manipulation? Or does one more wave of forced selling come first before the bounce? Monday's Asian opening tonight decides. About 75% of you watching aren't subscribed. If this unfiltered, real-time analysis is cutting through the noise and giving you a clearer edge on what's actually happening in these markets, hit subscribe. That's how we grow a community built on truth, not hype. If it's not for you, no hard feelings. I don't chase empty metrics. I'm here for those who want clarity over polished narratives. Do your own due diligence. Understand the risks. Be accountable for your own decisions. Have a clear plan and know your time frames. Are you trading the hourly chart or are you investing on a 10-year thesis? Those are 2 completely different strategies. If you're over-leveraged, margin hikes will force you out regardless of the long-term outlook. If you're positioned appropriately and stacking physical for decades, Monday's volatility is noise. Let's see what happens. But if you're new here and you don't have a plan, these volatile environments can destroy you. Invest with logic, not hype. Use your brain. Don't follow anyone blindly, including me. OG out.